These financial terms get thrown around everywhere, but most people have no clue what they actually mean. Understanding just these 8 concepts could literally be the difference between being broke at 65 or retiring a millionaire. So let's break down every financial concept that's been confusing you in the simplest way possible. First up, credit scores. This mysterious 3-digit number that somehow decides if you can buy a house, get a car, or even rent an apartment. It's like having a report card that follows you around for life, except nobody taught you how the grading system works. Your credit score ranges from 300 to 850. Below 580, you're basically financial kryptonite. Above 750, you're sparkling with adult credibility. Most people are stuck somewhere in the middle, wondering why they can't get approved for anything decent. Here's what actually matters. Do you pay on time? That's 35% of your score. How much credit are you using versus what you could use? That's 30%. The rest is just how long you've had credit and what types. The crazy part? You can have 0 debt and still have a trash score if you don't have credit history. The game is rigged, but once you learn the rules, you can rig it back. Next, compound interest. This is either your best friend or your worst enemy, and most people have no idea which one they're dealing with. Einstein supposedly called it the 8th wonder of the world. Whether he actually said that or not, the man had a point. Here's the deal. Simple interest is like, here's a flat fee, thanks for playing. Compound interest is like, every dollar I gave you now has clones and they also want rent. Put $100 in a savings account at 1%. In 30 years, you'll have $135. Exciting stuff. Put that same $100 in investments averaging 7%. You'll have over $760. But here's where it gets scary. That same compound magic works against you with debt. Miss a credit card payment at 20% interest. Your $12 burrito turns into a $50 regret faster than you can say financial mistake. The rule is simple. If you're paying compound interest, kill it fast. If you're earning compound interest, feed it and let it grow. Inflation, the silent wealth killer that nobody talks about at parties. You know that feeling when you buy a bag of chips? Open it up, and it looks like it's already been half eaten. Then you check the price, and it's 30% higher than last time. Congratulations, you've been hit by inflation. Inflation is what happens when money slowly gets less valuable over time. Your $5 bill is still technically $5, but it buys less gas, less food, less everything. It's like your money is on a diet you never signed up for. A little inflation is normal, even good. 2% a year? That's fine. But when it spikes to 8%, 9%, 10%, your savings account becomes a slow-motion bank robbery where the thief is time itself. This is why keeping all your money in a regular savings account is actually losing money. You're not keeping up with inflation, you're falling behind. The stock market, where fortunes are made and lost, and where most people think it's basically legalized gambling. Spoiler alert, it's not. Well, it doesn't have to be. When you buy a stock, you're buying a tiny piece of a company. If the company does well, your piece becomes more valuable. If it tanks, well, so does your investment. The key is this: the stock market goes up and down daily, but over decades, it generally goes up. Since 1926, the S&P 500 has averaged about 10% returns per year, not every year average. Some years it's up 30%, some years it's down 20%. But if you can handle the roller coaster and stay invested for decades, historically, you win. The people who lose money are the ones who panic sell when it drops and buy when it's expensive. They're basically buying high and selling low, which is the opposite of making money. Mortgages. The 30-year commitment that makes marriage look like a casual fling. Most people sign up for the biggest debt of their lives without understanding what they're actually agreeing to. Here's the reality. You want to buy a $300,000 house, but you don't have $300,000. So the bank says, no problem, we'll lend it to you. But here's the catch. Over 30 years at 6% interest, you'll actually pay about $540,000 for that $300,000 house. You're basically buying the house twice. But here's a hack most people don't know. If you can afford a 15-year mortgage instead of 30, you'll save hundreds of thousands in interest. Yeah, the monthly payment is higher, but you'll own your house in half the time and pay way less overall. It's like choosing between a slow financial bleed or a quick financial sprint. Taxes, the inevitable life event that somehow nobody prepares you for. You work hard all month, then get your paycheck and wonder where half of it went. Welcome to adulthood, where the government takes a cut of everything. Income tax hits the money you make. Sales tax hits the money you spend. Capital gains tax hits the money your investments made while you were sleeping. The government has figured out how to take a little bit of every dollar, and they expect you to say thank you. Here's what most people don't understand about tax brackets. You don't pay the highest rate on all your income. If you make $50,000, you don't pay 22% on the whole thing. You pay 10% on the first chunk, 12% on the next chunk, and so on. It's like a staircase, not a cliff, but the government makes you guess how much you owe, even though they already know. If you're right, great. If you're wrong, you're in trouble. It's like a game show where the prize is not going to jail. Banking, where you think your money is sitting in a vault being guarded by dragons, but it's actually already gone. Most people think banks are like giant safes, but they're actually more like financial matchmakers. When you deposit $1,000, the bank takes $900 of it and lends it to someone who wants to buy a jet ski. They only keep about $100 on hand, betting that not everyone will show up at the same time asking for their money back. This is called fractional reserve banking, and it works great until it doesn't. Remember 2008? People lined up to withdraw their money, and the whole system almost collapsed. Banks make money by lending your money at a higher interest rate than they pay you. You're the supply, borrowers are the demand, and banks are the middleman taking a cut. The good news, in the US, your money is insured up to $250,000 per account. So even if the bank fails, the government promises your money is safe. Probably. Finally, risk versus return, the fundamental rule of investing that everyone ignores until they lose money. Want high returns? You've got to accept high risk. Want guaranteed safety? You've got to accept low returns. You can't have both. A savings account paying 1% is safe, but inflation is eating your lunch. Stocks can drop 50% in a bad year, but they've averaged 10% over decades. Crypto can make you rich overnight or broke by morning. Real estate is usually stable, but requires huge upfront costs. The secret isn't avoiding risk, it's managing it. Don't put all your eggs in one basket. Diversify. Some safe investments, some risky ones, some domestic, some international. The goal isn't to avoid losing money ever. It's to make sure that when you do lose, it doesn't wipe you out completely. So there you have it. 8 financial concepts that most people find confusing, explained in simple terms. Credit scores are your financial report card. Compound interest is either your best friend or worst enemy. Inflation is slowly stealing your money. The stock market rewards patience. Mortgages are 30-year commitments that cost twice what you think. Taxes are unavoidable but manageable. Banks are middlemen, not safes. And risk and return are joined at the hip. The financial world loves to keep this stuff complicated because confused people make bad decisions, and bad decisions make other people rich. So the next time someone starts throwing around financial jargon at a dinner party, you won't be the one nodding along pretending to understand. You'll be the one actually knowing what they're talking about. And trust me, that's a pretty good feeling, because the difference between financial stress and financial freedom isn't luck, intelligence, or even income. It's understanding these fundamental concepts and actually using them. And now you do. If this helped clear up some financial confusion, hit that subscribe button for more simple explanations of complex topics. Because money doesn't have to be mysterious, it just has to make sense.